Hi guys, good evening and welcome to Money Control. I'm Karunya Rao and you've tuned into Markets Weekly. It's been a rather interesting week for the Lal Street. We've seen some good gains coming by for the broader markets, along with, of course, the benchmark indices. Let's bring on board our guest for the day and talk to him about the big trends playing out in the market and how to sort of look at or relook at your portfolio amid all that's going on in the market. Anand Shah joins us from ICICI Prudential AMC. Anand, great to have you on board.
Hi, very good afternoon.
Hi, first things first. What do we make of the market right now, the mood that's there? Because we've seen a good amount of resilience come by in the last couple of weeks. This week as well has been fairly buoyant. Do you think that by the time we hit Diwali, the markets could reach once again sort of those all-time high levels of 18,600 or perhaps beyond?
I think, look, to be very honest, India has been having a fairly, uh, I would say, surprisingly good move. To be very honest, when you see the backdrop that's happening globally, we are talking of significant rate hikes in US, leading to a risk of recession in US. We're already seeing what's happening in Europe, where electricity prices have gone through the roof. China has zero COVID policy for some time now, which is leading to a significant slowdown in that economy. So we're talking of a very three large blocks having challenges. And in that backdrop, obviously the global growth is sort of at risk. Uh, Inflation is very high and no different for India as well. Uh, when you put all that together with monetary policies tightening, I think whatever we are having is actually very good. So you
Hmm.
have to appreciate that Indian equity markets actually riding against all the odds, and to
Yeah.
expect a lot more from here is in a short while is tough. Having said that, there are also reasons for markets to do well, and the foremost and the most important reason for markets to do well is actually a very strong earnings backdrop that we are seeing today. Along with the strong earnings, we have also seen the repair of balance sheet. You talk of banks, you talk of manufacturing companies. Most of the companies which were under stress, they're also seeing fairly good repair of balance sheet. So your balance sheets are improving, your P&L is improving, and most importantly, once these macro headwinds go away, we have also reasons to believe that the future growth outlook is also improving as we come out of pandemic. That is one future growth driver, but also exports picking up, global trade picking up. We've been also parallel talking of China plus one helping manufacturing exports. So I can also give you many reasons to
Hmm.
feel positive about markets, but in the very short term, I think we have had a very good run, and we should be very happy with what where we are today.
Okay, and I'm sure most investors are who are watching the show right now. But what about valuations? While we are in a very sweet spot, we've seen a good run up coming by, macros, micros looking good. Inflationary risks also, at least right now, look to be easing a tad. But what about the valuations given the run up we've seen of late? Are you comfortable with the way with the valuations at present?
As I said, look, as long as earnings are supportive, at some point of time, valuations can remain expensive for a while. So, like, they're not very expensive, they're not very cheap, but I think I would want to move beyond broader markets. And when I segment the markets into two, there are set of businesses which are trading at a very high PE multiples. Those are the businesses which did extremely well through the last decade when generally the earnings were not great. So we had challenges in earnings at a India Inc. level, at the macro level, but many of these consumer-facing businesses did extremely well in last decade. So those are trading at a very premium valuations. At the same time, the businesses which were not doing extremely well, or where some of them were doing very badly in last decade, those were impacted by global deflation, the manufacturing aggression of China. Those were actually today also trading fairly reasonably priced.
Hmm.
For the reasons one would want to believe that what has been the past, if it were to be going to be get repeated in the future also, you don't want to own them now, because then we are talking of a slowdown in the earnings. That's where we sort of differ a bit. But to come to your question on valuations, I think it's a mixed bag. While on the broader basis we are fairly okay, but there is a segment of the market which is very richly priced, and they're having some earnings headwinds, whereas there is a segment of the market which is fairly reasonably priced or maybe cheaply valued, but they're cyclicals. They are in the industrial space, and their history is not great. So a lot depends on how they fare into the future for them to
Hmm.
continue to do well.
Right. What about the flows? FIIs have made a solid comeback. July was the first month after a very long time when we saw, positive foreign inflow. August again, 18,500 crores worth of buying happened. Can this momentum sustain? And do you think both DIIs as well as foreign investors could continue pumping in more money in the markets? Are there enough triggers in place?
I will not bet too much on that. To be very
Okay.
honest, global monetary tightening has just started. Obviously, the first round we saw massive selling by FIs. We might not see the
Hmm.
repeat of that, but we will have bouts of FIs flowing in or flowing out at aggregate level. Uh, DIs will remain supportive to me. I would not be too worried there. The SIP has become a very large part of inflow, which is fairly stable. So net net, we will still see inflows in from the domestic investors. FIIs would continue to have some sort of cyclicality there, and one should be prepared for that. Uh, but I think more importantly, again, I will repeat, the market from here on will be more bottom up. So, do you have right
Hmm.
companies in your portfolio? Because while the FIs might not be a very big net buyer, we have seen very recently they have bought significantly in banking, and that's been sort of a big outperformer. So, you want to be in the segment of the market where one, earnings growth is strong, the return on equity in that companies or sectors are improving, and obviously the valuations are reasonable. When you have all the three uh, falling together, and that's been the case for banking, we have been talking about it for now more than a year. uh, Banking was also the segment where FIs were a big sellers prior to July, but they were also very big buyer there. So there
Yeah.
are pockets where you can still do stock picking, and that would be the key in generating outperformance or benchmark or generating returns for investors in 12 months to come.
One question that we got from our viewers is that how should we go about building the portfolio if we want to start at this point in time? Because there is definitely a lot of nervousness, a lot of a lot of people have not seen events like Russia, Ukraine, so much volatility in, slow moving assets like gold, so much volatility in oil prices. So, for those who want to begin constructing their portfolio, how should they go about stock picking or even investing across assets amid times like this?
Indeed. I'm very surprised you didn't speak about the pandemic because, this is what happens. So, markets will always remain uh, volatile. I don't think we can wish away the volatility in equity markets, and there is merit to it. I will come to that a little bit, but this is not the first time that we are seeing uncertainty in equity markets. In 22 years that I've been in the markets, we always have uncertainties. Very few times then that we didn't have uncertainties. Trust me, they were not the best time to buy markets because markets could be very expensive at that point of time. So I think to be very practical about it is that actually all these uncertainties that are there in the markets, they provide an opportunity when the valuations and the expectations from the businesses become reasonable. And to that extent, I don't think one needs to worry about this short term volatility. Rather, as I was saying, one needs to embrace volatility, because volatility in the equity markets is the reason why equity markets also, relative to the other asset classes, deliver you a superior returns in the long term. So,
Hmm.
what you need to worry about is risks. So, volatility is a temporary fall in the asset prices, which invariably comes back when economy normalizes, companies' earnings normalizes. What you need to worry about is the risk, which is a permanent loss of capital. Which are the businesses which are at risk? Which are the businesses which will tend to go towards zero or can fall by 50, 60, 70%? And that's where the analysis of business management and valuation, all three, that forms a very core part of our stock selection process, is very important. Coming back to the investors, I think if you're a first time investor, one first and foremost, you come with a very clear 5 year, 10 year investment horizon minimum. If longer, the better, because this is an asset class where you are entering into a partnership with businesses. And when you buy a single share or when you buy an equity, you are in a way a partner to that business, and to that extent, you need to have a really long term horizon. So don't think of investing in equity markets for the short term, because that's always uh, risky. So, one, when you have time on your side, then obviously you want to benefit from volatility, for which obviously over years SIPs and STPs have become very, very popular, and they've been also very, very effective in the volatile times like this, because that reduces the overall loss to the portfolio in an event of a fall. At the same time, uh, people can participate more when the markets fall. So I think SIP, STP is another way of. But before SIP, STP comes asset allocation. So that's where also somebody will have to evaluate. Each one has his own asset allocation, depending on the age, depending on the profile of your liabilities and your assets. One has to do asset allocation, and then once you decide there is this percentage of your wealth you want to put in equity, then use SIP, STP as a route to start investing in equity markets, and most importantly have a long term horizon in equity market. That's your best friend, to be very honest.
All right. Since you were talking about SIP, I want to just flag off the developments that we've seen today itself. Amphi data has said that inflows into equity funds have fallen to a 10-month low. Of course, they still remain in the positive territory, but uh, there is clearly a downtrend. 10-month low is not a small number. But let's talk about buying an SIP, because I was just getting a question as well from a viewer saying that should I buy or start buying an SIP now that the market has run up so much? Is it too late? What would you say to such people and budding investors who are still mulling it over and are worried that they've missed the bus?
No, I think the whole concept of SIP is that you're avoiding the timing of the market. Now, again, to say the market is already too high uh, is an assessment. I don't think anybody can for sure say that there's a peak of the market and market is going to fall from here. We have seen in the past when the earnings growth momentum is strong, and which is the case in India today, markets can remain expensive for very long periods of time till the earnings growth continue to be strong. So we don't know if whether we are at a peak of the market, we are halfway through the market, or we are at the bottom of the market. So the whole idea of doing SIP is that you remove the timing of the market. Now, if you really want to time the market, then as well do a lump sum investment or a short term STP or something. But the SIP as a product is really a product for you where you remove the timing. You have a fixed income which is coming through, and you want to put part of that into equity markets, meant as a savings for long term, because you might not need that money for next 10, 15 years. That is the money you commit in that SIP, right? So I think one need not worry about the market levels, is my personal belief when it comes to starting an SIP. Having said that, if you
Hmm.
are of if an investor has a conviction that the market is going to fall from here, they can start partly with SIP, and partly they can keep that money aside to do lump sums at some point of time. But again, there it is the investor and the advisor who has to sit together and take that call.
Just one more follow-up question again from an audience member. He wants to know if if for a beginner, index funds are the safest bets, rather than looking at, the whole gamut of offerings that are there on the table.
Of course. So I think index funds any day is better than, uh, if you were to say, a relatively safer investment avenues like fixed
Yeah.
income and bank deposits and others. So that's your first step. If you're really unsure of choosing the right vehicle, then obviously index fund is the first step. But again, I would want to believe that this is only the first step. This is not the last step. Once you enter the equity markets through a passive fund which delivers you the index returns, one will also have to explore and saying in a developing market like India, there's always opportunities beyond index, and that is a well captured through mutual funds or PMS or AIFs. So those are the something which also the investors will it will be right thing for investors to explore, because in India is an emerging market. There is enough
Hmm.
and more companies outside index, enough and more sectors which are not part of the large cap index, where the growth is much faster than the overall economy, and that's where India has been a very nice market for the active funds management. Also, we have a very large section of investors who are investing into active mutual funds, active PMSs, and the AIFs.
Okay. All right. Another question from, again, our audience members is about investing in gold. You were talking about asset allocation. And given the recent cool off and retreating that we've seen in gold prices, should they buy gold right now, not just to diversify, but also to sort of hedge their, or sort of safeguard their investments overall? Because if the markets um, typically go one way, gold seems to go the other way. So is that a good idea?
I think you have nailed it, Karunya. I think gold is really an asset, which is an what would I say? It's an asset which thrives when actually everything else struggles.
Yeah.
It's an hedge to the inflation. So if you were to take a very extreme view that despite of all the efforts by central bankers, be it in US, be it in Europe, they have been raising interest rates to curb the inflation. If there is a view that they will be behind the curve, they will not be able to control the inflation, we would have then wage inflation spiraling into a multi-year inflation, hyperinflation cycle. Then I think gold will be a asset ideally which should do well. Similarly, that multi-year inflation will lead to further tightening of the monetary policy, which would be negative for equity markets. So, uh, typically, gold does best when otherwise both equity markets and fixed income markets might struggle as the U.S. Fed and the other central banks keeps on chasing the higher inflation through higher and higher interest rates, more tightened monetary policy, which is leading to a slower growth in the economy, hurting equity. I would say equity market potential returns also. So yes, gold is an interesting asset, which, to be very honest, have underperformed the growth assets like equity for a very long period of time, because we had a very benign inflation and a very low volatile growth in the global economy. When the environment is very nice, gold is not the right asset class. So gold in a way is a good hedge, where you can have part of your gold depending on how fearful you are of the global growth and global inflation. I think that's my answer. Do I have a view on gold currently? No, I don't think we have a very strong view on gold yet. We are still evaluating, because if the US Fed is successful in keeping the inflation expectation low, and at some point of time the commodities cool off, which has already begun, sustains, then maybe we are not really looking at a very scary scenario ahead.
Right. Okay. I want to steer back the conversation to equities as well. If we look at the run up of Nifty to those all-time highs earlier on, There were different sectors that were propelling that and that were supporting it. This time around, as we are inching closer to those levels, the winners are completely different, and the themes are completely different. So, talk to us about the themes, the sectors that you are betting on right now that could not only pull the markets up in the next few months, but also that one can play for the long term.
Indeed. I think the way we at ICICI Prudential alternates, we've been reading the market is, I think for a very long period of time, uh, consumer facing businesses had a very good environment.
Yeah.
What was happening is China was becoming one large manufacturing giant, in a sense that from safety pins to boilers, from tiles to tires, anything that can be manufactured, China was able to manufacturing in a mass at a massive scale at a very reasonable cost. And there are reasons why they were able to produce that at a very reasonable cost, including government support. Uh, so much so that we had the globally we had a deflation globally. The inflation was very benign, which I was talking about a little while ago, uh, which means that the consumer facing businesses had a very low input cost inflation, and they had some pricing power which allowed them to expand margins by 500 to 1000 basis points. In the same breath, during that period, if you were a manufacturer of the goods which China was exporting to the world, you were at a receiving end in terms of pricing pressure, margin pressure, low utilization, so on and so forth. And to that extent, if you see prior to December 2019, January 2020, a lot of B2C business were the driving force on the equity markets, whereas the manufacturing was at the receiving end in terms of a lower growth or a negative growth on the share price. I think that's where we believe slowly and steadily the trends are changing. China is sort of tightening their pollution norms, tightening their low cost funding available. Their labor cost is becoming more expensive. They have taken a big step toward decarbonization of their own energy production as well as manufacturing. So China is taking a little different direction as they have now become more moving towards becoming a developed nation. Their prosperities and the per capita income have gone up. So they want to do more high-end manufacturing, but that's also leaving behind a set of low-end manufacturing, the commodity manufacturing, which needs to move out of China. And that's where we have seen significant inflation, which we are recently talking about, which means that now the input costs for the consumer companies are not as benign as it used to be in the last decade. They need to pass it on to consumers at a time when consumers are not ready. There has been a margin
Hmm.
squeeze to these businesses. And at the same time, the manufacturers which have survived last decade and a half of Chinese competition, be it in metals, be it in textiles, be it in engineering, auto ancillaries, they are actually expanding margins at this point of time. They're benefiting from the inflation that we are seeing at this point of time. So if you see the big winners of last 2 years actually are in manufacturing, in to some extent in mining, uh, in capital goods, in logistics. So a lot of B2B businesses which have been at the receiving end and were underperforming B2C businesses, which are consumer facing businesses. The tide seems to have turned, and we believe it is structural and not cyclical.
Hmm.
While there will be inherent cyclicality within this structural part, but I think structurally B2B companies which have right to win, which have sustainable competitive advantage, the cap good companies, the logistics companies, uh, which are leading overall in last 2 to 2.5 years, we believe they will continue to lead the overall recovery.
Okay. All right. What about the more talked about themes, especially the ones that have done well, the likes of auto, the likes of banking? Could they sustain their momentum, or do you think it's more of a temporary flavor and and they've seen a fair amount of upswing already, and they could now start consolidating or becoming relatively muted.
I think thanks for asking this, because banking is something which I didn't touch upon, but I believe that's another segment which sort of hurt in the last almost 7 to 8 years, starting from the asset quality review, which was sort of taken by RBI in 2000, late 2015, early 2016, is when a lot of infra assets, a lot of manufacturing assets turned NPAs, and the banks had to provide for that. Subsequently, we had Demon, we had RERA, we had GST, we had an NBFC crisis, real estate slowdown leading to a builders crisis. So I think we had a plethora of reasons for which the banking earnings growth was negatively surprised, as they provided for all these NPAs. While they were sort of recovering from that, we got hit by the pandemic and the COVID wave 1 in March 2020 and COVID wave 2, the Delta variant in the March 2021, led to next round of provisionings the banks had to make for MSMEs and for the retail, respectively. I think that difficult phase for banking is behind us. In the meanwhile, banks have also, increased their standards, credit standards for which they lend. They have tightened their norms further. So I think banks is another sector which we might have a multi-year cycle where the credit cost will be far benign than what we have seen in the last 7 years, and that will immediately improve the earnings and the ROEs for these banks in medium term.
Okay. And IT, do you see it making a comeback anytime soon, or will it still remain out of favor?
No, IT even today is if you see from a long-term perspective, is done very well. IT continues to, be very solid businesses run by solid managements. So I have no doubt in my mind that IT sector as a whole should continue to create wealth. But in the short term, I think one will have to appreciate that they were also one of the big beneficiaries of the lockdowns, global lockdown and local lockdown, where uh, corporates could spend much more on IT, as they had to spend much lesser on office people, uh, on travel and other space. At the same time, the IT companies also had a margin tailwind because of a lower visa cost and lower travel cost and all that. As the economy opens up, the corporates globally will have to spend beyond IT into other areas also, and to that extent they will have less money to spend on IT. So there has been a severe slowdown versus expectation in the IT spends. That's what we are hearing from IT companies at this point of
Hmm.
time. At the same time, they are also facing margin pressures from higher employee costs, travel costs, visa costs, and so on and so forth. And to that extent, there's a brief, I would say, a period where the market's expectations will have to readjust to a lower growth and a lower margin. Once that happens, I think this is a solid sector which has still, good prospects ahead.
Okay. Before we let you go, Anand, just want to understand if you have any words of wisdom or any tips for our viewers to sort of go stock picking or to start investing amid current market scenario, anything that they should keep in mind?
I think from the investor's point of view, to be very honest, uh, the investing will become very very difficult. So even in the last year, so many investors and distributors were looking for products in the startup space, knowingly very well that they don't have cash flows, they don't have you know profitability, and the valuations were too high. But nevertheless, that was sort of a flavor at that point of time, and we've seen now what happened to many of those companies and stocks, somewhere listed, somewhere unlisted. So I think
Hmm.
for investing directly into equity markets, you need to have a solid advisor. You need to have somebody who can, take you through the nuances of the market, the complexities of the market, Even with us having 20-member research team and few fund managers in our team, it's not easy that we can predict the various things, because as you rightly said, a pandemic was one new thing. The Russia Ukraine is something we have seen for the first time. So markets are difficult, and becoming difficult by the day to call. And to that extent, obviously over years the mutual fund industry, uh, the alternates business, they have all well developed very well, and that those services are available to the investors at a very reasonable cost. So I think that's one they can look at definitely. But otherwise, even direct investing, you should have a very strong advisor on your side. That is what I would say, because while this is one of the finest asset classes which has potential to create a lot of wealth, but it comes with its own risks. And if you're stuck in the wrong business or a wrong management, you can actually lose a lot of money also. So it's not very straightforward, is what I would say.
Okay, all right. It was great chatting with you, Anand. Thank you so much for sharing all of your observations, your insights, and learnings from the current market scenario, and giving a glimpse to our viewers on what lies ahead. Thank you so much. It was great having you on board.